This video is going to be a little bit different as I'm going to riff my way through a number of charts that will help you stay the course when the investment markets are bouncing around. As a result of watching this video, you'll be in a much better position to avoid the mistake most private investors make and therefore enjoy a successful investing experience. Hey there, welcome back to the channel. If you're new here, my name's Hugh. I'm a retirement specialist and money coach at Proposito Financial Planning based in the Cotswolds in the UK. In this 444, I'm diving headlong into a topic that's on everyone's mind whenever the markets get a little shaky: how to stay calm and focused during large market swings. We all know that seeing your portfolio lose value can be unsettling. The knee-jerk reaction might be to move everything into cash, but believe me, that's not the best move for long-term gains. We've evolved to run away from pain, but this doesn't serve us well when it comes to investing. Staying invested, on the other hand, is a surefire way to avoid the pain that most private investors experience. So grab a cup of tea, get comfortable, and let's dive into these 4 insights that will help you navigate through turbulent times with confidence. And they are: investment timescales. How often should you look? Investment windows. Over what time period should you look? Investment drops. How often does the market go down and up? Investment behavior. What should you do when the markets go down? Now, before I get going, we're looking to grow this channel so more people like you can find our content on YouTube. So it'd be really helpful if you can hit that like button, subscribe to the channel, and ring that notification bell. That way you won't miss out on our next video. Right, let's get started. Here's an investment. It doesn't matter what the investment is. It's a 60-40 investment. It's irrelevant. It just shows what's happened to that particular investment over the last 5 years by looking every day, daily valuations. This is the same investment, but instead of looking every day, it's just been valued weekly. So you're looking once a week. Now, what happens to that investment if we look monthly? Well, this is the shape of the investment, exactly the same investment, 60% stocks and shares. The investment's irrelevant. This is just the time periods, the frequency that we look. The time period is the same, 5 years. And then this just shows the shape of that exact same investment if you look quarterly. And when we compare those charts side by side, you get to see that the less often you look, the smoother the investment journey. The same investment, each of these 4 charts is the same investment over the same time period. The only difference is how often you look. And so if you want to make your investment portfolio less volatile, just look at it less often. Because by looking quarterly, you have a much smoother curve than if you look daily or weekly. The second idea is, here's 4 investments. Which one do you like the look of? So the one in the top left looks like it's just gone plunging down. The one in the bottom left, the blue line, it's gone horizontal for a bit and then gone plunging down, a little bit of a recovery towards the end. In the top right, the light blue line, it seems to have dropped down, moved sideways for a period of time and then gone up. And then the green line in the bottom right-hand corner, it seems to have gone up. But yes, it's gone up and down, but the general trend is up. And, if you were to pick one of these investments, which one would you choose? Now, if you're like most people, you're going to choose the one in the bottom right, the green line. But here's the thing. Each of those charts is part of the same chart. Each of those 3 lines, the red line, the dark blue line, and the light blue line, they're part of the green line, just taken over different time periods. So the red line is a 10-day period somewhere on that green line. The dark blue line is a 10-week period somewhere on that green line. And the light blue line is a 10-quarter period, so 2.5 years, somewhere on that green line. But I think we'd all agree we want the green line. And all you have to do to get the green line is to sit through that red line, which is a bad 10 days, sit tight through that dark blue line, which is a bad 10-week period, and sit tight through that 10-quarter period where it's gone down and then seems to move sideways for a long period of time. I mean, it moved sideways for a couple of years, but you've got to sit tight. And let's have a look at where those time periods were. You know, you can see the 10-day period is a short part. The 10-week period's quite little. That's the COVID crash. And then the 10-quarter periods. But looking across the 10-year period, the returns have been pretty good. And actually the returns, this particular investment, and it doesn't really matter, but it's been 100%. But in order to get that 100% return, you got to sit tight through some pretty ropey investment periods. The next thing to look at is how often do market drops occur. So this chart shows a particular investment from 1999 all the way up to 2023. And the two bits of this chart are, the black line is the investment return in that calendar year. So it's how much did it grow or drop from January to December in that particular year. Where the black line is above the horizontal line 0%, that is positive returns in that calendar year. Where the black line drops down below 0%, that's a loss in that particular year. The red bars show you the loss during that calendar year, the maximum drop that happened during that calendar year. And the point to note here is there's a drop in the investment markets every single year, but most years the market recovers to record a positive gain. And the message is that there's a 10% drop in the markets about as regularly as you have a birthday every year, and you should expect a 30% plus drop on average once every 5 years. Now these are a feature of the market, not a flaw. Remember, risk and return are related, and if you expose yourself to the short-term risk of drop in capital values, then you get rewarded for the risk of the rebounding additional returns if you can sit tight and stay the course whilst the markets are bouncing round. Every year, Dalbar publishes its annual survey, which is a look back at the last 30 years to look at investor return, investment return, and what cash and inflation have done over the same period. This chart shows the latest Dalbar study, which is the annualized 30-year return. So it looks at returns from the start of January 1994 to the end of December 2023, and then it just produces an annualized return. So during that period, inflation was on average annually 2.52%. The return on cash on average was 2.77%. But here's the important numbers. The return on the S&P 500, so the investment return, was 10.51%, but the average investor return over the same time period was 8.01%. That's over 2% difference in returns. And that's down to investor behaviour. Every year, the Dalbar study shows the same thing, that investors achieve less than investments. Okay, and let's look at what those percentages mean over that 30-year period. Over that 30-year period, inflation would have turned $100,000 into $210,000. So $100,000 of spending 30 years ago, that same spending would cost you $210,000. $100,000 put in the bank will have delivered $226,000 in cash. $100,000 invested into the S&P 500 would have delivered $1.8 million. $100,000 invested by the average investor 30 years ago has delivered $1 million. There's more than $800,000 between the investment return over 30 years and the investor return. And the difference is down to investor behaviour. And it's known as the behaviour gap. This is the difference between what investments have returned and what investors get. And it's down to how they behave when the markets are bouncing round. And the Dalbar study finds the same three reasons for this variation in investor return compared to investment return. And they are not being sufficiently diversified, trading too often, and buying high and selling low. And this chart from the Behavior Gap, Carl Richards, who does the sketch guy in the New York Times, sums up exactly what happens. The market's going up, private investors pile into the market near the top, and then the market crashes near the bottom, they sell, they can't take it, and they just keep going until they run out of money. Or they never go back into the market and they sit in cash. It's possible to represent this chart using emojis. The emojis are great because they show exactly what's happening. You know, everything's going well, everything's rosy. And then down here, things not looking great, feeling sick, praying. And then we just repeat the cycle again and keep going. The successful investor is down here and just remains invested for the whole time. Doesn't look at their investments very often. Understands that they're not looking at a 10-day window, a 10-week window, a 10-quarter window. They're looking at a 10-year window, and they're looking less often to make their portfolios less volatile. Now, it's important to remember that there's only 3 things you can do with money. So investing's great, but it's really important that investing is what you do with money to enable you to spend it. And the only 3 things you can do with money is you can once you've paid all your bills, you can spend it today on having fun. You can invest it so you can spend it tomorrow on having fun, or you can give it away to people or causes that you care about. You can't do anything else with it. So remember, when you're investing, the investing is not the end itself. The investing is the means to an end. It's to enable you to grow your capital ahead of inflation so you get to spend it, maybe get to spend more of it at the point where you need that capital. Often people will save money, and I don't really like the word saving. It's deferred spending. They'll not spend it today so they can invest it. It can grow ahead of inflation to spend it tomorrow. And the important thing when it comes to investing is what it enables you to do and what you can control and what matters. And that's what you should focus on. So there you have it, 4 key ideas to reassure you that sitting tight is often the best thing to do when the markets are bouncing around. If you've enjoyed this video, then show us some love, like, subscribe and hit the notification bell. And if you've liked this video, then I'm sure you're going to love this one, which is all about the best long-term investment, cash, property or shares. Thanks for watching, and I'll see you in the next one.